Welcome to today's video on why the Health Savings Account, or HSA, might be the most powerful retirement vehicle you can use. To set the stage, we will outline how the HSA's triple tax advantage can outperform other accounts when used strategically. Then, we will walk through the savings priority order, practical steps to max it out, and a smart receipt strategy that turns your HSA into a flexible, tax-free engine. Finally, we will test your knowledge with a couple of quick quizzes and wrap with key takeaways. Here is our agenda. First, we will define what an HSA is. Next, we will break down the triple tax advantage. Then, we will review the recommended savings priority order. After that, we will cover step-by-step instructions to fully leverage your HSA, including a powerful receipt strategy. We will also clarify what changes at age 65. Finally, we will reinforce learning with quick quizzes and key takeaways. Before we proceed, please note this video is for educational purposes only and does not constitute financial, tax, or legal advice. Individual situations vary widely based on plan details, income, state tax rules, and personal goals. Consult a qualified professional to tailor these strategies to your needs. Additionally, always verify current IRS limits and eligibility rules for HSAs and high-deductible health plans. An HSA, or Health Savings Account, is an account that must be paired with an eligible high-deductible health plan. It is designed for qualified medical expenses, but the key idea in this strategy is to treat the HSA as an investment account rather than a spending account. You can pay current medical expenses out of pocket and let HSA funds grow for decades, then reimburse yourself later. Let's break down the triple tax advantage. First, contributions are pre-tax or tax-deductible, which lowers your current taxable income. Second, the growth within the HSA is tax-free, so dividends and capital gains are not taxed while inside the account. Third, qualified withdrawals for medical expenses are tax-free, which means you never pay tax on those dollars when used properly. This combination is unmatched by other common retirement accounts. Next, let's set priorities. First, capture your 401k employer match because it is effectively free money. After that, prioritize maxing your HSA because of its triple tax advantage and long-term flexibility. Then, if you have additional capacity, max your Roth IRA for tax-free withdrawals in retirement. Finally, add more to your 401k beyond the employer match. This ordering helps optimize both tax efficiency and growth potential. Here are the practical steps. First, confirm that your health plan is an HSA-eligible high-deductible health plan. Next, open an HSA with competitive fees and solid investment choices. Then, automate contributions through payroll or recurring transfers to reach the annual maximum. Importantly, invest your HSA balance into low-cost, diversified index funds to capture long-term growth. Pay current medical expenses out of pocket and save every receipt with details including date, provider, amount, and the service description. Maintain a digital folder and a simple spreadsheet to track contributions, receipts, and any reimbursements. Later, you can choose to reimburse yourself strategically, possibly during high expense years or when it best fits your cash flow. At age 65, non-medical withdrawals become penalty-free, though still taxable like a traditional IRA. Let's detail the receipt strategy. You pay current medical bills out of pocket and preserve every receipt. Meanwhile, your HSA funds stay invested and compounding without interruption. Carefully document the date, provider, amount, and the nature of the service. Save PDFs of receipts, explanations of benefits, and proof of payment. Organize them in a cloud folder with a local backup, and track them in a simple table, noting whether you have reimbursed each expense. You can choose to reimburse yourself years or even decades later, which provides flexible, tax-free cash when you need it most. Here are general guidelines. Eligibility requires an HSA-eligible high-deductible health plan without disqualifying additional coverage. Contribution limits change annually and depend on whether you have self-only or family coverage, so verify with current IRS publications. If you are age 55 or older, there is typically an additional catch-up contribution allowed. Confirm the current allowance. Note that a few states may not follow federal HSA tax rules, so check your state's treatment. Qualified expenses are those defined by the IRS, and you must retain detailed receipts. For non-medical use before 65, distributions are taxable and penalized. After 65, Non-medical distributions are taxable but penalty-free, similar to a traditional IRA. Quiz time. Which statement best describes the HSA's triple tax advantage? Option A. Contributions are pre-tax, growth is tax-free, and qualified withdrawals are tax-free. Option B. Contributions are after-tax, growth is tax-free, and all withdrawals are tax-free. Option C. Contributions are pre-tax, growth is taxed annually, and withdrawals are tax-free. Option D. Contributions are taxed, growth is taxed, withdrawals are untaxed. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is: contributions are pre-tax, growth is tax-free, and qualified withdrawals are tax-free. This is the unique combination that drives the long-term superiority of an HSA when used strategically. Let's compare an HSA with a Roth IRA. The HSA allows pre-tax or tax-deductible contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses. After age 65, non-medical withdrawals become penalty-free but remain taxable like a traditional IRA. In contrast, a Roth IRA uses after-tax contributions, provides tax-free growth, and offers tax-free qualified withdrawals in retirement, but it lacks the medical expense reimbursement feature. Both accounts are powerful, yet the HSA often takes priority after capturing your employer 401k match because of the triple tax advantage and added flexibility. At age 65, the HSA's rules change in your favor. Before age 65, non-medical withdrawals are both taxable and penalized. However, once you reach age 65, non-medical withdrawals are still taxable but no longer penalized, which makes the HSA function similarly to a traditional IRA for non-medical purposes. Qualified medical withdrawals remain tax-free at any age. This makes the HSA a highly flexible retirement resource later in life. This timeline illustrates a typical HSA life cycle. Initially, you enroll in an HSA-eligible plan and open your HSA with automated contributions. Over the first decade, you pay medical expenses out of pocket, save every receipt, and keep your HSA invested. Over the next decade and beyond, compounding and tax-free growth accelerate. At any point, you may use saved receipts to reimburse yourself tax-free. After age 65, non-medical withdrawals become penalty-free, while medical withdrawals remain tax-free. Quiz time again. After securing your 401k employer match, which account should typically be prioritized next? Option A, max out Roth IRA. Option B, max out HSA. Option C, max out 401k beyond the match. Option D, pay off all low-interest debt first. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to max out your HSA after capturing your 401k employer match. The triple tax advantage and the ability to reimburse medical expenses later make the HSA a high-priority account in many financial plans. Here are the key takeaways. First, treat your HSA primarily as an investment account to capture long-term growth. Second, follow the recommended savings order of operations: 401k employer match, then HSA, then Roth IRA, and finally additional 401k contributions beyond the match. Third, pay medical expenses out of pocket and save receipts to enable future tax-free reimbursements. Fourth, at 65, the HSA becomes penalty-free for non-medical withdrawals, though still taxable. Finally, consistent contributions and compounding produce strong long-term results. To summarize, HSAs deliver a triple tax advantage that, when combined with long horizons and consistent investing, can surpass other accounts. Use the HSA primarily for future medical expenses and avoid halting contributions just because you have saved one or two deductibles. Employ the receipt strategy to preserve compounding while maintaining flexibility for future tax-free reimbursements. After age 65, your HSA becomes even more versatile for non-medical needs. As always, verify current IRS rules and your state's tax treatment before making decisions. Thanks for watching. If you found this valuable, please like the video, share it with someone who needs to hear it, and subscribe for more evidence-based wealth strategies. In the comments, tell us your HSA approach and any questions you want us to tackle next.